Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PROPETRO Holding CORP quarterly report. PROPETRO Holding Corp provides a range of integrated oilfield services to various industries. The company's services include hydraulic fracturing wireline services, cementing other complementary oilfield completion services for non-oil and gas applications such as, plus general industrial projects, plus data centers. The significant surge in PROPETRO Holding Corp's stock price by 55% in the past year can be attributed to several key factors. Firstly, an Investing Pro fair value alert identified the company as undervalued, triggering a substantial increase in share value. Additionally, strong earnings performance, particularly in Q1 and Q3 of 2025, contributed to the stock's upward trajectory. The company's strategic expansion into power generation through its PROPWR division has also been a major catalyst for growth, with significant milestones achieved and contracted capacity exceeding expectations. Furthermore, PROPETRO's commitment to advanced fleets and technology has supported pricing power and stable cash flow. Overall, the combination of these factors has driven the stock price increase, reflecting the company's strong financial performance and growth potential. The primary drivers of revenue growth or decline are largely influenced by strategic business decisions, market conditions, and industry trends. Key factors contributing to revenue growth include the acquisition of Aquaprop, LLC, expansion into new business units such as wet sand service, and increased demand for hydraulic fracturing services due to growing Permian Basin activity. Conversely, revenue decline is primarily driven by decreased customer activity in hydraulic fracturing, sale of cementing businesses, reduced demand for completion services, and decreased customer pricing in wireline. These factors highlight the importance of adaptability and responsiveness to market fluctuations in maintaining a stable revenue stream. Net income and profit margins. A shift in performance. The financial performance of the company underwent significant changes between 2024 and 2025. On a positive note, net income increased by $120,797,000, indicating an overall improvement in earnings. This growth was also reflected in the quarterly results, with a notable increase of $134,702 in the 3 months ended September 30, 2025. However, this upward trend is not consistent across all metrics. Profit margins took a hit, decreasing from 19.7% in 2024 to 12% in 2025. This decline was also observed in adjusted EBITDA margin, which dropped from 18.9% to 16.1%. The hydraulic fracturing segment results showed a more pronounced decrease of -3.8% or -15% in adjusted EBITDA margin. The reasons behind these contrasting trends are not explicitly stated, but it is clear that the company's financial performance has become less efficient over time. Despite the increase in net income, the decline in profit margins suggests that the company may be experiencing growing pains or inefficiencies in its operations. The company is indeed generating positive operating cash flow. The financial summary explicitly states this, and the numbers on pages 10 and 52 support this claim. In both years 2024 and 2025, the net cash provided by operating activities is significantly higher than zero, indicating a strong ability to generate cash from its core operations. This trend suggests that the company's business model is financially sustainable and capable of producing positive cash flow, which is essential for long-term success. The company's debt level and interest expenses have shown some fluctuations, but not necessarily significant changes. The total debt level has increased from $407,372 to $453,403, with long-term debt rising from $45,000 to $86,904. However, this increase is relatively modest. Interest expenses have been inconsistent, with a slight 8.8% rise from $1,939 in 2024 to $2,110 in 2025, but also a decrease of $0.2 million, 3.4%, at another point. Overall, there is no clear indication of a significant change in interest expenses or debt level across the report. The company's financial performance varied across different segments and regions in the recent period. Notably, hydraulic fracturing and cementing were the underperforming areas, with significant declines in revenue, -23.6% and -18.7%, respectively. In contrast, wireline services saw a notable increase in revenue, 9.1%, while the Permian Basin, Delaware Sub-Basin, and Midland Sub-Basin regions all performed well. These results indicate that the company's growth was driven by its wireline services and strong regional performance, but was hindered by challenges in hydraulic fracturing and cementing. Management's outlook and strategy. The company is shifting its focus towards a more sustainable future by transitioning its fleet to lower emissions equipment. This strategic move aims to capitalize on growing demand in the Permian Basin, particularly in drilling and completion activities. To achieve this, management plans to invest in new equipment and extend asset life, while also expanding services through acquisitions like Aquaprop acquisition. Key drivers of growth include expanding business through acquisitions, investing in lower emissions equipment, capitalizing on growing demand in the Permian Basin. Management's emphasis on providing competitive pricing and meeting customer needs at a lower environmental cost positions the company for future success. The company has made several strategic acquisitions and divestitures to enhance its operations and focus on core businesses. Acquisitions. The company acquired Pioneer Pressure Pumping for $110 million in cash and shares. It also entered into a subagreement with XTO Energy Inc. for hydraulic fracturing services and purchased Aquaprop's operations and Par 5 Energy Services LLC. Additionally, the company invested $186.6 million in mobile natural gas-fueled power generation equipment and approximately $81.2 million in additional power generation equipment. Divestitures. The company divested its cementing business located in Vernal, Utah to Big Four for an undisclosed amount. It also sold its investment in Step Common shares for $9.4 million. The company's financial summary reveals that it has engaged in share buybacks. Specifically, the company has a share repurchase program and has utilized funds for future repurchases, with $89.2 million remaining authorized as of September 30, 2025. This is further supported by a decrease in share repurchases of $55.7 million, indicating that the company has indeed bought back shares. Supply chain disruption looms large. The financial summary highlights a pressing concern for businesses. Supply chain disruption. Several factors contribute to this risk, including cost increases, supply chain constraints, Middle East hostilities, and increased tariffs. Furthermore, equipment manufacturers are struggling with contractual arrangements and supply chain tightness, which is negatively impacting their operations. These disruptions can have far-reaching consequences, from delayed shipments to stockouts, ultimately affecting the bottom line of companies. As a result, businesses must be proactive in mitigating these risks by diversifying their suppliers, investing in logistics infrastructure, and developing contingency plans for potential disruptions. That concludes the financial summary for PROPETRO Holding CORP. Feel free to comment below, and I will be happy to answer them when possible.